Hi, I'm Ryan Guina. I'm the founder of the Military Wallet. I'm joined today by Mike Hunsberger. Welcome, Mike. Mike is a 25-year Air Force veteran and the founder of Next Mission Financial Planning. He's a certified financial planner. I'm excited to bring you on board today and talk about some personal finance fundamentals, and we're going to really expand this conversation. So thank you for joining us.
Thanks for having me, Ryan. I'm really looking forward to talking today.
All right, so let's just dive in and let's make this hard. We're going to start with a four-letter word, budgeting. All right. Talk to me a little bit about budgeting. Why is it important? Who should do it? I'm going to throw that to you.
All right. So I think there's two reasons for budgeting. One is for awareness, just understanding where your money's going. A lot of that's looking backwards. The second one would be control. You want to make sure that the money that you have coming in is going to those places that matter most to you. So those are really the two kind of things for budgeting. Who should do it? Most people should definitely have the understanding piece, track it in some way because, again, money's important. Typically say, if you want to know what somebody values, you look at where their money's going and, what their calendar looks like, where their time's going.
Yeah.
So just having that, I think, is important for everybody. The control piece, if money's tight, that's definitely a place where, you probably want to have a better idea specifying, hey, I'm going to pay myself first, direct money to those things that are most important. And then, maybe you control a little bit less whatever's left over.
Yeah, that makes sense. I know when I first started and I built a budget, I felt like, gosh, this is restricting. Obviously you're looking backward, trying to figure out how much did I spend on housing or food or everything else. But as I got better at it and I knew where my money was going, I actually found that it was liberating because I could look at my paycheck and I could say, okay, I know this is my rent every month, this is my insurance, this is my car, what I spend on gas and food, and now I have this buffer at the end, and it became liberating because I knew I could spend that and not overextend myself.
Exactly. Come up with your priorities. The one other saying in personal finance is pay yourself first. We're going to get into the savings and investing piece, in a little bit, but, having those things earmarked, like you said, okay, I know housing is this. I'm also going to direct this part of my paycheck directly to, either the emergency fund or something else ahead of time and making those decisions. So it's not every month I got to willfully decide what I'm going to do, and there's a lot of tools now, from the banks have them to other personal finance tools where you can make this pretty much automatic as you want, which makes it a lot easier. So you're not having to, pull out that willpower every month when you really want to go and, go out to that nice dinner. You've already done the things you're supposed to first, and then can, enjoy, like you said, that whatever's left over, you got that budget to do with whatever you want.
Yeah, and, decision-making fatigue is a real thing. In the military, we have our SOPs, right? Standing or operating procedures. And doing that is one thing for when you're fixing an airplane or a tank or whatever, and lives are on the line. You have to follow those rules. But there are other times when having those SOPs is just helpful because you don't have to make that decision. You know how to wear your uniform. You don't have to go in the closet and pick something out. You just put the uniform on, follow the rules, you're done. So it takes that decision-making process out and allows you to free up your willpower, as you said, for more important things. You also mentioned emergency fund. Now, I know that's something, a word that gets kicked around a lot. Can you tell us what is an emergency fund to you, in your words, and how much should I be saving in my emergency fund?
Yeah, so the emergency fund is just that money you have set aside for things that come up periodically. Again, an emergency, something that you don't do regularly, that's not planned for, but you want to have that money so you're not having to put it on the credit card or worrying about it excessively because you just don't even have the funds at all. So that's kind of what I think of the emergency fund is for. How much should you have? General kind of rule of thumb is you want 3 to 6 months of your spending. Now that can vary widely. For military folks that have the regular check coming in and know how long their enlistment or how long their terms of service are as an officer, maybe you don't need quite that much, just because you've got a more steady paycheck. Now, if you're, on the, you've been in the military, or, not in the military, and you've got a sales job where your income is very, fluctuates wildly, then you may want 6 months, 9 months, a year, built up, just so that, again, something happens, you're prepared, the jobs don't come in like you think they will, you're ready to go, and you don't have to worry about it.
Yeah, I know that when I was enlisted, my first duty assignment was RAF Lakenheath. So I was over about an hour and a half, hour 15 minutes from London. Great assignment. I didn't have any debt, so all I had to worry about was myself. I lived in the dorms, and my expenses were basically, gas money, insurance, and random meals in pubs, right? So my term for an emergency fund back then was if I need to buy a last minute plane ticket to get home, and it could be up to $1,000. This was 20 years ago, but a last minute ticket, not cheap, right? So that's how I looked at it. And but as my life has changed and my needs have changed, my emergency fund has grown from $1,000 to I was self-employed for a long time, and my income did that. So I looked at it as, okay, I need to be more toward that 6 months just in case. So, but you also brought up a good point. It's based on your expenses, not your income. Right?
Exactly. Yeah.
Because you can always dial back. Okay, let me dial back my discretionary spending or investing for a while, so I can focus on the emergency needs that I have at this moment.
Exactly. And then if you use it, the first thing you want to do is build it back up. So when the emergency's done, you want to make sure you replenish it.
Yeah, great information. So no one size fits all answer. It's really dependent on where you are in your stage of life, what your financial situation looks like. Wonderful. Okay. Now let's talk about something that kind of ties these together. When we start looking at our budget and we start looking at how much is coming in, how much is going out, what's related to this is our net worth, right? So we've got the things that we own, the things that we're paying toward. How should we be looking at that, and how should that influence our financial activities?
Sure. It's again a building block approach, but net worth is really just your assets minus your liabilities. And assets are just things you own. Liabilities are something you owe. So an example would be if you own your home, that is an asset. But if you've got a mortgage, you also have a liability there. So you've got two pieces of those things. And so you just add it all up. You want to take your savings account, your checking account, again, vehicle potentially, but a house. If you've got investments, a retirement account, or stocks, bonds somewhere, those type of things, you'll add that all together to kind of come up with, okay, these are all the assets. And then again, you'll look at, what's the debt I owe? Do I have credit card debt? Do I have student loans? Do I have a mortgage? And, pulling that all together, you take your assets, subtract your liabilities, that's your net worth. And net worth can be negative. So if you've got, you have a lot of student loan debt when you're starting out, and not much in the asset column, it could be negative. So, debt is a really important thing that I know we're also going to hit, but that's really the net worth piece. And again, as you progress on your financial journey, the goal is to have that net worth slowly climb over time. As you accumulate more assets, you build up the retirement fund, again, potentially buy the house and start paying off the mortgage, all those things. It's something that's useful to track just to see where you are.
Yep, that's great. I've been keeping my net worth really for, over probably close to 15 years now. I'm a nerd, so I keep it all in a spreadsheet. But what I like and why I started doing it was shortly after my wife and I got married, I was trying to figure out, well, okay, she has this account, I have this account. What do we have? What do we owe? And that kind of stuff. So it helped me get a better picture of our financial lives. But it's important to remember, a net worth is just a snapshot in time. It's not your personal worth. But It's something that helps you have awareness of where you are and where you're going. So over time, you want to see that number grow. But it also gives you an idea of, oh, I owe this money toward my house, student loans, medical debt if you have that, car loans, credit cards, etc. So as we're looking at our net worth statement and you see your liabilities, those are probably some of the higher numbers on your budget as well. So that's a good way to look at how those work together. So as you're looking at your budget, you might see, okay, I have this credit card statement and I've got $100 a month payment on that. But you look at your net worth and you see it's a $5,000 liability. You might look at that as a way to maybe change your budget so you can tackle that a little faster. So how do you approach debt reduction, identifying which debt to pay off more quickly? Should you pay it off more quickly? Let's talk about that a little bit and how you approach it.
So, there's several different methods that folks use for that. Some folks like to focus on, hey, I'm going to knock out the smallest bill if they've got different size. You've got 3 credit cards. One has $500 on it, one's got $5,000, and the other maybe $6,000. And they'll say, I want to knock out the smallest and just get that done. And then, they call it the snowball method, where you're, picking up steam and just knocking out bigger and bigger, debt chunks as you go. The other thing that you can look at is, what's the interest rate on those debts? Because again, credit cards right now, typically 18 to 20%, and that is a lot. So compared to like mortgage debt, which could be 6, 7, if you locked in 3-4 years ago, you could be sub 3.
Yeah.
So that's probably the way I like to look at it is, credit card or high interest debt, you want to try to knock that down as fast as possible. And I'd even pare back maybe even some of the emergency fund, leave some in there that you need, but you're just sending money to the credit card company or the bank that owns the credit card, and you're not really getting anything for that. It's just money that's going to their bottom line. So if you can get the high interest rate debt knocked down first, then you can make decisions. Does it make more sense to invest? If you have a sub 3% mortgage, probably, right now, even just in a money market fund, you can make more money. You make 4% on your money versus paying that down. Now, sometimes that's a personal preference. Just, hey, I like to sleep at night. I want to get debt free. Even no car loan, no home loan, no debt at all before I, start investing. But really, that's a personal kind of preference.
Yeah, so basically there's no one size fits all. And that's why they call it personal finance, right? It's personal, it's what applies to your situation. So as we were talking about emergency fund earlier, you could look at that as a basic emergency fund versus a fully funded emergency fund. Sure. So for me, when I lived in England and I was a young airman, it was just me. $1,000 should get me home if I needed to for any emergency. But when I had a family, wife and kids, a business, my income was variable, I wanted a fully funded, which I looked at as about 6 months of living expenses, not income, but living expenses. So most people are probably going to find themselves somewhere on that spectrum for their emergency fund, somewhere between a family of 4, we're living in Germany, we need to get home to see my parents for an emergency. What does that cost? 4 tickets, rent a car, etc. But you're still in the military full time. You're still going to have that paycheck coming in. You're not worried about losing your job. So maybe that basic emergency fund for them might be $5,000. But fully funded, you'd have to take that out a few months. Yeah. Those are great tips and great ways to look at an emergency fund. So coming back to the debt question, tackling that debt, I agree with you. I like to knock out that high interest, but the debt snowball is a very popular thing. There are a lot of tools and calculators that can show you how to do that. Some people prefer the debt avalanche approach, which is attacking the high interest first. As we're moving toward that and we start knocking off these debts, and we're starting to get to that point where, okay, I've eliminated most of my high interest debt. I might have a mortgage payment, or let's say I have a student loan that's locked in pretty low and I'm comfortable with that. It fits into my budget. Now I'm finding I have a little bit of a surplus every month, and cash flow's coming in. I've got a few $100s coming in, or maybe it's more. How should I start approaching that surplus with my cash? Should I just drop it in my savings account, put in what should I do with it, right? So, because if I don't do anything with it, I'm going to go out to eat, I'm going to go clubbing with the boys, or whatever. We're going to go do something, and that money's not going to be there. So I want to get that as part of my budget, so it's allocated. Pay myself first. What do I do with that?
So again, some of it will depend on comfort level, and some of it will depend on what are you saving for. So if you know you're going to need a new car in 2 to 3 years, maybe saving is the right, a savings account, preferably a high yield savings account, because, one of the things people come in, see me, and, they're doing the right thing. They built the emergency fund, and it's at a standard bank that's paying, less than 1%. If you look at that, with inflation right now running 3%, you're actually losing money over time. And that just pains me. So, one of the things, foot stomp, is, hey, look at high yield savings accounts. Lots of them online now, super easy to set up. You can transfer money directly from the bank. You can get it back to your bank within, a day or so. So again, for, that initial savings, even the emergency fund, that's a great place to store that money. But if it's a longer term goal, say you're starting to think, I would like to retire someday, maybe it's 30, 40 years off, but I know I need to start doing something, and I've got this extra money. So it could be, you said a couple $100s. Let's say you've got $200. Maybe you want to direct 100 of that to short-term savings because you are going to buy a car in 3 years, and then maybe that extra $100 you're trying to figure out on, do I have access to a retirement plan? Which, if you're military, you have the thrift savings plan, directing it there and just starting to get invested for the long term. If it's, kind of more of immediate, an intermediate term goal, like maybe a house down payment 10 years from now, still consider investing some of that, but you'd want to use more of a brokerage account, just similar to a retirement account, but you could buy stocks and bonds and just hopefully earn a little bit more money. But for that longer intermediate term goal, probably more, typically, longer than 5 years out, you want to start, looking at investing versus the savings piece.
Okay, so we're looking at, really, it's individualized, but it's looking at the right tools for the right purpose. So in this case, let's just say I started my career just a few years ago. In many young people, when they're starting off, you're probably going to be in a situation where your paycheck to paycheck are pretty close. There's not going to be a lot of extra surplus. But over time, we hope that as our earning capacity grows and our ability to pay off debt, have our emergency fund, we're going to start having a little bit of monthly surplus with our cash. So we can then start working towards short-term goals, which is more of our, emergency fund first.
Yep.
Then we'll have our short-term goals, say the next 1 to 3, maybe 5 years.
Yep. That
should be in cash, high interest savings account. And in there, that's going to be our things like, okay, I know I have a vacation coming up. Christmas happens once a year. Every year it happens. Sneaks up on people. But you've got your Christmas fund, maybe your car fund. Now we're looking at, okay, if we're going to start looking 5 to 10 years out, maybe we put some of that into a brokerage account where we can invest in something that's hopefully going to surpass inflation.
Exactly.
All right. Okay, so that's good. And now we also have the long-term goals where we're looking at retirement. And that's when we start looking at, you could also put money into a brokerage account so you have access to it at any time, but then you can start looking into retirement accounts such as the thrift savings plan or IRAs and things like that. Wonderful. Well, I think that probably sounds like it's a pretty big topic. So why don't we take a break, and we'll come back, and after the break we'll talk about different vehicles we can use for investing. Specifically, we'll dive into the thrift savings plan.
Sounds great.
All right. Well, thanks, Mike. Thanks for coming on, and thanks for all you do to the military community.
All right. Appreciate it.
Thank you.